Today is the 23rd of July 2010, and normally I don't talk too much about these broad markets, and for good reason, but today I want to bring up some information that I think is important and some stuff that I haven't heard really anyone talking about. And a lot of times, if you're looking to trade markets within this channel, make the ideas that I talk about your own. I talk about Fibonacci within the silver market and use those same Fibonacci methods for whatever stocks or indexes that you yourself could be trading, as they seem to work on many different occasions, basically making the trading ideas your own. And a lot of the reason why I don't like talking about it is because of the form of gambling this happens to be that is really not mentioned throughout the mainstream media or from the casino brokers, which is really the financial institutions, making it even much worse, in my opinion, anyway. And the topic that I want to talk about is tops and bottoms on the intermediate term time frame, or for some people, maybe the long term, depending on what you consider intermediate term. And I have the chart scanning back from pretty much 207, pretty much year 2007 into 2008. And I want to talk about a pattern that I noticed in 2008, which I called the 2 month pattern. And what this pattern is you have markets or situations where markets go bullish to bearish to bullish to bearish and so on. And the bottom, which we can notice here on the 14th of March, this is a 2-day chart. Each candle represents 2 days. We'll switch it to one when we go to the 2008 data. But this bottom of 1363 in March 14th topped out in July. That's 3 months. Generally speaking, in a bull run, a lot of times you have very tiny retracements. These two retracements here would be considered tiny enough where this June top is really not a significant top, where this one here would be. So on the 17th of July, the market topped, thus bottoming on the 16th of August. And another thing is a lot of times the selling can come faster than the buying, and this was exactly the case here. For it took 3 months to go from this level down below here up towards here, and it hit that pretty much same point in about a month's time frame. Nonetheless, it bottomed on the 16th of August. It topped again here on the 12th of October, which is still the nominal high. And, well, that was 2 months or so, about 2 months. And it came back down close to that level again on the 26th of November, so about a month and a half or so. It made this low, or it went from this is the start of a bearish cycle. This was the end of the bearish cycle, which thus turned bullish, and the bullish time frame was short. And that's what happens sometimes if you notice that you have 6 weeks down, 3 weeks up. It's most likely going to be a bearish pattern, as 4 months up and 6 weeks down would, generally speaking, be a bullish pattern. Therefore, you hit a bottom on the 26th of, or we'll say late November '07, topping on the 12th of December '07. That's only about 2-3 weeks. And so you didn't have that much of a gain, and then a big push to the downside, thus breaking this key support level. And the December 12th top ended up bottoming on the 24th of January. And you can even make a case for this level here. So we'll say about a couple months, as it did range for a few weeks. And the significant bottom was the 17th of March, which rallied up to the 19th of May. So if you're thinking, well, things are fine right now with the stocks, well, they were hyping it up back towards here. There was an inverted head and shoulders pattern that broke out on the 21st of April, just like we're going to see an inverted head and shoulders pattern today when we get to the end of this chart. But it topped out on the 19th of May. It bottomed on the 15th of July, which was pretty much 2 months. It says the 16th on the top left of your screen. But it's a 2-day chart. It was the 15th when it actually bottomed, and it was the 19th when it topped. So therefore, 2 months or so, and the next move would bring us to the 11th of August. And a move from July 15th to August 11th is a little under a month's time frame, and thus it only got a small percentage of its previous losses back. What we're going to do now is we're going to switch this onto a daily chart because it starts in August. And the August 11th top is up towards here. The bottom I was using was October the 10th. And you could say, well, wouldn't you be using this level here? And well, maybe it's the same as it was in January of '08 where it raged for a little bit. And pretty much yes. But the reason why I used October the 10th was, well, August the 11th was 2 months of a time frame. And then it rallied in 3 candles. This candle, which was the bottom, the morning of October the 10th, the huge day on Monday the 13th, and then the gap open on Tuesday, brought a difference of a high of 1044 and a low of 840. That's over 200 points, or about 25%. So we talk about the big volatilities markets can have. When you break down a support level of 1220 and go down to 840, that is extremely volatile, big time. Therefore, the top on the 14th of October at 1044 ended up bottoming in November around the 20th, we'll say, at 740, we'll say 750. So that was a period of a little over a month's time frame. We'll move ahead just a little while, and we can see that it went from a late November bottom to an early January top, which was January the 6th, though about 6 weeks. Very normal within this pattern. And then the market collapsed down to the March bottom, which are still the nominal lows over the last so many years. 2 months. So therefore you'd be thinking, okay, well, we'd be topping late April into May. And here we are here at the end of May. And I could be honest with you, I was looking at this level, at this range at the time, and I was thinking a serious retracement coming. I thought there was a nice rally where it was going to make a higher low from this level, but at least a test down towards this 800 area. Well, that never happened because it kept going higher and higher. And when you have bull runs, a lot of times the retracements can be tiny. Retracement here, which is tiny, this one here, which is tiny, and thus the run, which would take us from March bottom to the top here in June. That's 3 months. And its retracement was July the 8th. So that was only about a month's time frame. The next move, you can see some small retracements, but you probably have to go the September highs. And even then, it only retraced for a week or so. So you know what? You really can't even count that. So I guess we can say the top would be October the 19th. Therefore, the run was about 3.5 months. A lot of bullish sentiments. I feel like for fundamental reasons, printing of excessive money might be the reason. After all, the casino makers can make this happen with printed money. Therefore, the run down from the October high brought us to a retracement that lasted only about 2 weeks. The next move lasted for quite some time again. We went from November the 2nd to January the 19th. So about 2.5 months to the upside. There hasn't been any retracements during this bull run. We had a definite significant one here from January the 19th down to February the 5th. Once again, that was only about 3 weeks, but it had the gains that took almost the entire run to get there, like we were talking about in the 2007 at the start of this video. Its next bull run was from this level in February the 5th up to this April 26th high. So once again, a little over 2 months of a time frame. We had these May 6th conspiracy lows, and I really use the word conspiracy with a lot of pride because it does seem as if a lot of what's going on with the market does not justify what's going on with the economy. And there's a lot of conspiracies going on behind the scenes within the market, or at least so it seems from what I have noticed. However, with that being stated, if you're playing, that's why you never know what to expect. Be careful to ensure that you get your profits along the way. Nonetheless, the top here of April the 26th found a bottom on July the 1st. So there's a 2-month move, its first move of significant proportions since the bull market has begun. First time we've seen the 50-day moving average ever decline like this during this run. So now today, just like we were talking about in April of '08, we have this inverted head and shoulders pattern. We have been in this bull market now for about 3 weeks or so. And if we're going to run a 2-month interval course, then most likely what you would have happen is a break of this trend line and thus finding an area of resistance towards 1175, 1180. And by the time that completes, this started on July the 1st, that should get us to the end of August into the area of Labor Day. And if that becomes the case, then maybe we can stay in a bull market and we won't have another serious retracement until 2011 or sometime. Who knows? It's part of the casino game that's not a free market. Because, in my belief, I think Goldman Sachs knows entirely the general direction to which the market's going to be going, not only in the month of August, but throughout the fall of 2010. And that's my opinion, but if we're playing this 2-month game, and say it managed to get up to 1162, it would thus be a lower high from this level towards here. And if it does 2 more months to the downside, especially if volatility picks in, because a lot of times the moves to the downside can be a lot more greater than they are to the upside, at least in the broad markets, then that could mean an easy test of a breakout below this key 1,000 psychology mark. Of course, I don't know exactly what's going to happen, and people ask me, well, when's the stock market going to crash? Well, it's crashing now, and it's been crashing for a decade when you price it into real assets like gold or silver. But in dollars, it's about $1 fallout, not so much about stocks, although stocks are affected in dollars, thus it would be affected also. And if a major hyperinflationary situation comes into play, do you really think we're going to have the S&P falling down to 300 or 400? I think it's potential we could have deflationary first, and if that's the case, then most likely we would have big retracements to the downside. But with that being stated, if you are getting out of the dollar by investing in stocks is not getting out of the dollar. Now, if the broker can say, okay, I want to buy this particular stock, but I want to give you 5 pounds of silver. And then, however the stock works out priced in silver afterwards, I want to get paid back in silver. Meaning, if the stock does well priced in silver, maybe I can get more silver. And then, of course, if it loses, I would get less. That's pretty much how gambling works. And the game you're playing is within the financial institutions as the casino brokers. You go to their webpage, you will not see anything about responsible gambling or anything within that nature. And I think they do that because they realize that humans see gambling as something negative, when in reality, it's a form of making wagers to go either higher or lower, and gambling can be a positive venture. If you know what you are doing. But they don't want to get people out of the market, because I think if they were to educate people that this is like playing poker, playing blackjack, or anything of that nature, the amount of participants would reduce big time, and it would cause a large sell-off in the market. That is my personal opinion. Because in this game of stocks, there has to be a loser for every winner. And when you're paying commission fees and any type of penalties or any type of bank fees that you get, because you know that's what the banks like to do, well, then you have it. You are paying more, that's your VIG, and the majority of people are most likely down. Now, if we look at this on, say, a monthly chart very quickly, and you could state, well, they state a lot of buying and holding over the long term. And assuming that you were buying here at, we'll say February of 99, S&P 1200, you could say, well, I'm selling now, I'm up 100, which is like 10%. Do you really think that inflation has been lighter than 10%? Because if you're trading in these markets on the longer term time frame, inflation becomes an issue, which is why these markets are getting crushed in gold and silver right now. And no, you're not doing well if you bought at this level, because the prices of the average amounts that you buy, the increase in taxes, and those kinds of things have far greater increase, 10%. Far greater increase, you know what I mean. It's increased well more than 10% in over 10 years. So they don't give you that kind of information. So when you're playing that game, you're watching Mad Money, you're really working within the agendas that they are talking about. So I'd like to thank you for watching this video and have yourself a magnificent weekend. Bye-bye.